Now, the South African Reserve Bank has kept interest rates unchanged, with the repo rate at 6.75% and prime at 10.25%, following a split MPC decision. Governor Leseja Kganyago said global growth remains resilient despite uncertainty, while inflation has eased. South Africa's growth has been driven mainly by household spending, as investment stayed weak and contracted in early 2025.
Markets are jittery, and precious metals like gold have received safe haven flows. There are also ongoing risks of an artificial intelligence bubble. Furthermore, global imbalances have become very large. For instance, China's trade surplus was over $1 trillion last year, a new record. Meanwhile, government debt is still growing fast in key economies. For example, with the US fiscal deficit approaching $2 trillion. These trends are not sustainable. Despite these fragilities, asset prices have been resilient and global growth is holding up, supported by investments in AI as well as fiscal stimulus in major economies. Inflation generally slowed last year, and many central banks have had space to adopt more neutral policy settings. Financing conditions for emerging markets remain benign. Turning to South Africa, growth looks steadier. The economy has expanded for 4 consecutive quarters, and the available data suggests it grew further in the most recent quarter. This would mark the longest unbroken growth phase since 2018. The main growth driver has been household consumption, which is up by more than 3% last year, compared to an estimated 1.3% for the overall economy. Unfortunately, investment has been weak, contracting during the first half of 2025. However, the third quarter data showed a rebound. We hope this investment recovery will be sustained, allowing the economy to achieve structurally higher growth. Our forecasts continue to show growth moving somewhat higher, approaching 2% over the medium term. We see some upside risks to these projections. Moving to prices, inflation last year was 3.2%, close to our 3% objective. It was a bit higher towards the end of the year, mainly because of temporary factors. The December print came in at 3.6%. However, we expect this was the peak and that inflation will slow from here. Indeed, over near-term inflation forecast has fallen, with the rand stronger and a lower oil price assumption. We are, however, keeping an eye on food inflation, especially meat prices, which are being affected by a serious outbreak of foot-and-mouth disease. We are also concerned about electricity prices, given that NERSA's price correction may rise from 54 billion rands to 76 billion rands. More positively, inflation expectations have fallen, with the latest survey showing longer-term expectations at record lows. We look forward to expectations declining further as South Africans experience ongoing lower inflation and learn more about the new target. In turn, lower inflation expectations will be important for getting inflation to settle at 3%. Currently, we are benefiting from low goods price inflation supported by factors like the stronger rand. Goods inflation is at 3% and core goods is at 1.2%. By contrast, services inflation is still over 4%. It is desirable to have services inflation moving closer to 3% as low inflation becomes the new normal for South Africa. We assess the risks to the inflation outlook as balanced. Against this backdrop, the MPC decided to keep the policy rate unchanged at 6.75%. 2 members favored a cut of 25 basis points, while 4 preferred a hold. The quarterly projection model continues to forecast gradual rate cuts as inflation subsides. The model interprets the policy stance as moderately restrictive currently, with rates reaching neutral levels during 2027.